You want to get started investing. You have no idea where to get started. I was there too. I mean, totally and hugely confused. I'm going to walk you through how I did it and arm you with a direct path to successful investing. You're listening to the Modern Kings podcast, your source of life-changing information for upgrading your lifestyle and unlocking your keys to success. Welcome to Modern Kings. What's happening, everybody? I'm your host, King Prime. I can be found at iamkingprime.com. And in today's episode, I will share with you how I did it, how I started investing when I was totally clueless and lost. And I'm also going to tell you what not to do, because there's a big lesson in that as well. There are quite a few things that I wish I did, especially in my 20s. I'm going to share some of those hard lessons that I've learned along the way. Here's what we're going to cover in this episode: which company to invest in, what companies are out there, how to set up your account, what type of account do you select once you do set it up, how much do you really need in order to get started, and you're also wondering, what do I even invest in? The questions go on and on and on. When do I buy? When do I not buy? We're also going to cover the power of compound interest and employer contribution programs. Let's roll. Okay, you may want to get a pen and paper for this. You may want to replay this episode. You may want to bookmark sections of it. We're starting with the companies. Now, there are so many companies out there, from the beginner to the super advanced technical day trader. You've got Robinhood, you've got Webull, you've got Tasty Trade, you've got TD Ameritrade, Charles Schwab, you have Fidelity, you have Vanguard, and heck, you even have Cash App, believe it or not. Personally, when I sell goods, whether it's Facebook Marketplace or in person, I invest that cash right in Cash App, because I don't like money not being deployed, going out, having babies, and letting those babies grow. How are you going to set up this account? I'm not going to oversimplify it and say that it is just as easy as setting up a social media account, but it is certainly not rocket science. You're going to create a username, password. You're going to put your basic information such as birthday, social security number, address. You definitely want to set up two-factor authentication. And if there are any parts that you get hung up on while you're signing up, you can typically call the customer service number to any of the reputable platforms, and they will show you exactly how to set that up. And that's something that I highly recommend, that when you're setting this up, that you get a rep on the phone. They can walk you through that entire process, because if you're new to this, it is certain that you will have questions along the way. Now, the account types. You have IRAs, which stands for individual retirement account. You have a Roth IRA, which is the same thing, except for it is tax-free upon your retirement. So when you decide to retire, the taxes are already taken out, so all that money's yours. If you set up a regular IRA, your money is not being taxed up front, but it will be taxed upon taking withdrawals during your retirement. You have an individual stock account. In this account, you are buying any stock: Apple, Microsoft, Home Depot, and you can buy and sell as you please. You also have a 529 account. That is a college fund account, essentially for a child. You have the standard 401k, where you opt into that incentive through your employer. Your employer pays a portion of the money, you pay a portion of the money, and you select a pre-designated fund that the money goes into, and it grows from there. Now, if you're a small business owner like I am, you still have the ability to set up a self-employed 401k, and you can do the same thing with your business. So your business can contribute to your 401k, and then you, the person who you are an employee of your own company, you contribute to that 401k. So you want to look at these type of accounts, and you want to match up what fits your scenario best. Now, this part is going to sound like a commercial. How much do I need to get started? $19.95, but wait, there's more. No, seriously, you can get started with investing with as little as $100, maybe even $50, because you can buy partial shares. You don't have to buy a share of some stock that costs $800 per share. You can put your $100 or your $50 into that same share and just get a partial share. Things have become much more conducive and easier to the retail investor these days. And when you get started with as little as $100, you want to contribute consistently. What this looks like is having something like an automatic deduction taken from your paycheck and being able to be contributed into your investment account on a routine basis. This can be every week. This can be every 2 weeks. This can be once a month, but you just want to keep that going. Let's not forget about bonuses, pay raises, tax returns. If you do receive a tax return, that is what I would call extra gravy to add to the pile. Now, what do I invest in? This is a massive area. So I'm going to try and break it down to you as simple as I can. You have individual stocks. You also have index funds or futures, right? These index funds are like the S&P 500. Those are the 500 largest profitable companies in the U.S. economy. You have the NASDAQ, which have the 100 most technical, innovative companies in the U.S. You have the Dow Jones, which are the blue collar movers and shakers, your Walmarts, your Targets, your Caterpillars, your John Deeres, the things that make the blue collar, agricultural, hardworking part of the economy go round and round. You also have ETFs. They're considered like basket stocks. So you're in a sector and everything healthcare related falls into that. You also have mutual funds. Same idea. They're basket stocks. So say you buy a mutual fund that is in utilities. It's going to be most things or all things utilities, your Waste Management, your Duke Energy, all of these type of companies. Now you may ask yourself, what's the difference between this ETF and this mutual fund if they're both basket stocks? I'm so glad you asked. Mutual funds are actively managed. This means that someone sits behind the fund and they move certain stocks in and out to try and keep it on track. And they charge you a fee in order to manage that mutual fund. Mutual funds also have some stipulations on them sometimes. It's like a minimum investment. You have to have at least $3,000 or you have to have so much in order to enter the space. ETFs are passively managed, which means that they follow a track or a sector, but no one is particularly behind the scenes moving stocks in and out. You're just tracking an industry in the market. You also have REITs, REITs, real estate investment trusts. There's another option called life cycle funds. Say you pick a date, 2060, that's when you want to retire. So it will take everything that you have in your investments and it will aggressively invest that. Higher percentage in stocks, lower percentage in bonds, a bit in cash assets, and a bit in international stocks. And the closer you get to your retirement, the less aggressive it will be. These life cycle funds are also called target date funds. Then you also have dividend stocks. Dividend stocks are often built by people that want to live off of dividends paid from companies. A dividend is the amount of profit that a company has received, and they redistribute that profit back to the shareholders based on the profitability of the company. So many people will set up and build a dividend portfolio, and they will live off the dividends alone while continuing to let their principal grow. Okay, when are we buying? I set up my account. I know what I want. When do I buy? What you're probably going to try and do is time the market, which is the wrong answer. There's always the standard approach of buy low, sell high. But here's one thing that you will rarely be able to do, and that is time the market. Timing the market is impossible. Time in the market is far better than trying to time the market. If you look at a standard investment chart, investments continue, for the most part, to go up over time. So even if you invest, and you say, oh crap, I invested $2,000, now it's down to $1,600. I want to take my ball and go home. I don't want to play the game no more. You have to be in this for the long run. The market is always known as the comeback kid. So when you look at the power of compound interest, $100 invested today with $100 contributed over time, say 10 years, that is a massive amount of money that you will have with very little money invested up front. So the best time to invest is 20 years ago. Second best time to invest is today. Don't be a tomorrow type of person on this. Tomorrow. 20 years later, you're still talking about tomorrow and you could have been wealthy. Now, one of the easiest ways to enter this investment space is through your employer. Many of your employers out there have programs. If you're with the company for any reasonable amount of time, 3 months, 6 months, a year, they will offer you some type of investment/retirement option. When they offer that, don't leave that money on the table. If they are offering you up to 5%, 6%, whatever the percentage is, opt in, take it, say yes, and at a minimum, match what the company is contributing. Do not leave that free money on the table. Now, if you're doing that already, I applaud you. Congratulations. That's amazing. And remember, you can always open other accounts and invest more than what the company is matching. As a matter of fact, the company may not offer you a Roth IRA, and you may want to set up a Roth IRA. You may want to set up a dividend account. I just want you to know that you have alternative options to invest more money. So here's how we're going to move forward. You're going to check with your employer. You're going to check and verify within the HR department that your company does or does not have a retirement/401k option. Secondly, if they do, you're going to jump on that immediately and you're going to contribute a matching amount. Next, you're going to go through the list of brokerage firms that we went over above. Fidelity, Vanguard, those personally are my top two, but I want you to look through this carefully and I want you to select a brokerage firm that fits your needs. If you are hesitant and feel like you can't do this on your own, call the brokerage firm's customer support number. They will gladly walk you through because they want your business. Decide how much you're going to contribute. You sometimes hear this, you hear people say this, pay yourself first. Seriously, your bills, your entertainment, all the things that you spend money on, they're going to happen regardless. It's just like the IRS takes money out of your check first and immediately. Take care of yourself first. So when you take care of yourself first, you won't miss it. So take that automatic deduction out of your paycheck and invest it. I have so much freaking belief and so much hope for you to get started and for your fire to be ignited and for you to supersede any financial expectations that people have of you. I am personally a living witness of that. So thank you for tuning in. I appreciate you being here. Wherever in the world that you are listening to this podcast, whether it's YouTube, Google Play, Spotify, SiriusXM, Apple Podcast, I would appreciate if you found value to share this episode and to leave me a 5-star review. I would very much appreciate it. And remember this, with enough money, you don't have to look for the money in the haystack. You can buy the haystack. That's a quote from me, King Prime. Follow me on YouTube at King Prime. Follow me on Instagram at Iam.KingPrime. I will see you in the next video. Until then, look your best, do your best, and be your best.